Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tanbella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. Now, we have a special guest. I think this is the 3rd time that Gary has been on. Gary Schlossberg, who is Wells Fargo's chief economist. Gary, welcome back to The Best of Investing. How are you?
Just fine. Thanks for having me back.
Good. Well, you know what? I want to get right into it. The first thing I noticed before getting into all of the economic type stuff, I just noticed Silicon Valley Bank gets the okay to pay out $12.5 million in executive bonuses. I'm sure you heard about that. So to remind the audience, the bank had its issues and filed BK. How does that work though? With I'm sure everybody gets upset with it, but it's probably from like the year before the bonuses that they just haven't paid out yet.
I think it's something like that. There's certainly a contractual relationship there that has to be honored. And I'm assuming that was the case with Silicon Valley. Out beyond that, I'm just not familiar with it.
You know, it reminds me, do you remember during the Great Recession when companies like AIG had these trips that they went on afterward, and people were all upset. But then I had to I looked a little bit deeper into it because I had someone who was high up in the company, and they reminded me that, that stuff gets paid for like a year in advance. You don't just call up a hotel and say, oh, I need to block out 100 rooms tomorrow. So that stuff, I mean, it's like they already paid for it. It just, the optics didn't look very good.
Yeah.
So now you've been with Wells Fargo for how long now?
49 years.
Holy smokes. You should own the bank by now, Wow, 49 years. That's amazing.
And a few of us.
Are there a few people who've worked there longer?
There are a couple that have been out there as long, if not longer than me.
Wow.
It's been fun. It's been a wonderful place to work.
Sure.
It's changed over the years. You can stay with one bank, you go through several banks. It's just the way the industry works.
Yeah. Well, and it's funny because there were certain times when Wells Fargo had fantastic reputation about some stuff, and then other things with the accounts that were set up, but that's seems like a few bad apples kind of ruined it for the bank. But I always really enjoyed working with Wells Fargo on not only the commercial side but on the residential side too. So they had
that's great.
Yeah. No, they've been they've been very good in the past.
Yeah.
Why don't you tell us? I've got some questions here, but why don't you tell us what you're the chief economist here. What do you foresee going on in the economy?
Well, there's a real debate going on about just where we're going over the next couple of months. There are those of us that are looking for some sort of recession by the economy actually falling into a decline. We think ultimately unemployment rising, the unemployment rate rising, the labor market, which is very tight right now, admittedly, beginning to soften up just a bit. And then there are others that are looking at the recent data, and certainly the economy has a good deal of momentum going through the 3rd quarter of the year, feeling that we're well positioned for a soft landing where we see growth slowing down, but avoiding a recession, or no landing at all, just continuing to grow. Our feeling is that what we're seeing now is very common in the late stages of an economic growth cycle. Most importantly, we're looking at the financial markets, and it is mixed, but we see indications that things are tightening up. So I guess we're leaning toward the view that a recession is on the horizon. We do look for interest rates going up a little bit further because of that. And that, of course, creates a twofold headwind for the stock market, which we can discuss if you'd like.
Yeah, no, definitely want to do that. Would that maybe cause a little bit of stagflation though, with if a lot of unemployment starts happening?
Well, and that presupposes that inflation won't come down. Now, with the kind of slowdown that we're looking at, Inflation already is down dramatically. We peaked at 9% in June of last year, and we're
Yeah.
currently running year-over-year inflation at a little more than 3%, but that's still
That's
about a
not,
percentage point over the Fed's target rate. And so we
yeah.
can expect to see the Fed trying to wring inflation out of the system a little bit more, and that's where the higher interest rates come in. The environment that we see is a little bit different from what we saw 45 years ago when inflation was last this high.
Yeah, and I'd like to get into that because also where energy prices are and all that, because that has a major effect. All right, here's our first trivia question. And again, as a reminder, Gary, if you know the answer, don't say anything yet. Who was the first woman to win a Nobel Prize? That's our trivia question. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. You're listening to The Best of Investing with Edward Brown and our special guest, Gary Schlossberg, Wells Fargo's chief economist. Don't touch that dial.
Okay.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my special guest, Gary Schlossberg, who is the chief economist for Wells Fargo Bank. And our first trivia question, who was the first woman to win a Nobel Prize? Do you remember? You know, now you can say the answer.
I'm guessing Madame Curie.
That is correct. Can you give me the year?
No, probably in the 1930s, but that's just a guess, if not sooner, earlier.
Okay. Yeah, actually 1903. So you have the three
Oh,
and the
really?
zero. Yeah. Very good. I'm impressed. I do want to make a mention here for Mountain Mike's Pizza in San Rafael. Pizza the way it ought to be. Boy, I tell you, every time I've had that on as an advertiser, just saying the words Mountain Mike's Pizza makes me really like wanting pizza. And check them out in San Rafael. All right. Gary, you're talking about the difference between 45 years ago and now with the inflation and all that. Go ahead.
Well, there are fundamental differences, I think. Labor back then, unionization was a good deal higher, and we had more cost of living contracts, which admittedly protected workers, which was a good thing. But the downside was that it had the effect of perpetuating inflation. You had that interplay of rising prices, prompting higher wages, contributing to higher inflation down the road. Labor unionization at this point is less than half what it was when it peaked in the early 1980s. We didn't have globalization, all these low cost suppliers, like until recently China, other developing economies. We didn't have the technological advances like the internet that really increased price transparency, easier to compare prices. There are other things involved as well, but the market, I think, is more flexible now than it was back then. So if the economy
Okay.
slows, you would expect to see inflation being a little more sensitive.
Wow. Okay. You want to give us any kind of predictions for the stock market? With,
No,
with, with,
except to
with all
say
the caveats, the normal caveats. This is no real crystal ball. It's just an indication.
only one caveat. Our forecast has to be right. But if interest rates do go up a bit further, that creates a headwind by squeezing market valuations. The price you're willing to pay for a dollar of earnings, what we call the price earnings multiple. When rates go down, that multiple goes up. When rates go up, the multiple goes down. I
Yeah.
can explain it, but the bottom line is that that's the relationship. With rates going up, we see a headwind there. If the economy responds to higher interest rates and tightening conditions by slowing, that hurts earnings. And that, of course, is very important to the stock market. Put those two things together, we think the market will be facing more challenging times. How far down the market goes, difficult to say, but not collapsing, but moving lower before anticipating a recovery next year, beginning to rally.
Do you want to make any comment about what you think real estate? There's a huge difference between residential and commercial.
Right.
I mean, 45 years ago, you didn't have people working from home the way you do now. And then especially with crime in certain areas, LA, San Francisco, New York, a lot of people. In fact, I think even the Fed told people don't come to work because it's too dangerous. Just work from home. So what's that
Oh,
doing for the office buildings? Um,
yeah. Well, vacancy rates in the office area are high, particularly so in San Francisco. There is a tiering in the market. The really quality properties, I think, The vacancy rates are elevated, but not nearly as high as the overall average. The market will adjust. We're seeing the downside now, a lot of subleasing activity, existing tenants putting a lot of new space on the market. A lot of pressure there that could be aggravated by an economic slowdown.
Yeah.
The market adjusts. We're seeing some of the older properties converted to housing. It may be an extended adjustment. A lot depends on the local economy. Here in San Francisco, it depends on how quickly the economy can bounce back. And it is to some extent from artificial intelligence. We are seeing tech coming back a bit. So I wouldn't write real estate off. And it is very uneven. The real weakness in offices, less so in retail. You have warehouses that are doing reasonably
Yeah.
well, industrial properties. So as an investor, you really have to pick and choose in a fragmented market. Housing activity with mortgage rates going up, it's going to be more challenging in a market that I think until recently has been remarkably resilient.
Yeah, we talked about this on the show before, where for residential housing, there's so many other aspects. In rising interest rates. I think there was, I don't know what the statistics were, but a lot of people had refinanced houses when interest rates were low. And I happen to be one of those people. I was fortunate to lock in 1.99% fixed for 15 years. So yeah, I just happened to hit it right almost at the bottom, just total luck of the draw. So I wasn't planning on moving anyway, but in order to get me to move, I mean, it would have to take a monumental effort because, I can't replace 1.99%. I'd be borrowing at, 6% maybe, or whatever it is now. So
Magnify that to millions and millions, and you can see why home prices are resilient. The
yeah,
inventory of unsold homes relative to sales about half its long-term average.
yeah,
Normally higher mortgage rates squeeze demand, soften the market, lower prices. In this environment, we've had, as you pointed out, such a big increase in mortgage rates that people go through the same thought process you did, and you
yeah.
just don't see the turn. So for
The-
now, at
yeah.
least, the market is tight, but we're already seeing demand really respond to this latest run up in mortgage rates. We have weekly data called mortgage applications for home purchases, and they're
Gotcha.
down to a 19.5 low.
All right. Tell you what, we're going to go to a break. We're going to come right back. Let's go to our second trivia question here. What is the highest grossing R-rated film in North America? Call 888-912-1190. The first caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. Stay with us. The Best of Investing will be right back. Don't touch that dial. Hey, by the way, want to make a quick mention, though, for Palio Restaurant in San Francisco. I don't know if you've ever been there, but phenomenal food right in the heart of the downtown San Francisco area. Palio Restaurant. All right. Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, and my other co-host, Mark Hanf, just joined us. So very good. Thanks for joining us, Mark.
Absolutely.
Let's just answer the trivia question here for a minute. The highest grossing R-rated film in North America. Anyone know what that was?
Oh, I'm gonna recognize it when you say it, but no.
Actually, it was The Passion of the Christ. It was the highest grossing R-rated film. It was only R-rated because it was pretty violent. Quick mention here for San Francisco Bay Adventures, cruising out on the bay. Got to check them out. They have a really cool sailboat to
Yes, they are.
Bays, sfbayadventures.com. All right, we're back in the studio here with Gary Schlossberg, Wells Fargo's chief economist. And Mark, why don't you jump in? I know you've got some questions.
Yeah, sorry to jump in late on the show here, but Gary, thanks for being on again. Hey, I don't think you guys talked about this in the earlier segments, but we raise capital as part of our business model at Pacific Private Money, where we're private money real estate lenders. And what I found this year, for most of 2023, it's been a lot more difficult to raise the kind of capital that we do from retail investors who like to invest in private placements. We offer basically alternative investments or private placements, which are in the alternative investment category. And what I've found, and this is just anecdotal, but it's been more difficult to find people interested in what one might say are riskier investments, although we don't think real estate debt is a very risky investment at all. But it's just consumer sentiment in as I see it, being out there, trying to raise capital, talking to our existing investors. In fact, even our existing investors, many of whom have, contacted us to maybe redeem or pull some chips off the table out of their investments with us. It just seems like there's a lot of extra fear mongering going on in the media, which is nothing new, by the way, right? I mean, that's kind of the way it is. But would you agree with my opinion, which is, I think things are an awful lot better in the economy across the board with real estate and with other sectors of the economy than what you would maybe be led to believe if you're reading too much in the media, or worse yet, scrolling through your Google News feed and seeing, opinions from bloggers and other, maybe less savory news sources. I don't know. Are you running into that much in your line of work?
Yeah, I don't know that I'm as close to it as you are, but I can tell you that from the top down, from my perspective, certainly, the willingness was there with the economy holding up better than many people expected, generally speaking, through the better part of the year. I think there's a certain amount of apprehension about the economy losing some momentum. There's talk of a soft landing as well. So I don't think that's all of it. But there is a little apprehension there. We've seen interest rates moving up, and that could cause some concern in the investment community about an interest sensitive sector like real estate. May cause some concern not only about the overall economy, but certain segments of the real estate market. This is more cyclical, but a little uncertainty about the longer term outlook. And of course, there's been that press about commercial real estate, which has historically been economically and interest sensitive. The problem is that if you're not close enough to the market, you may not realize that commercial real estate in particular is very segmented. And yes, there may be problems in the office sector, but as I just pointed out a moment ago, less so in retail, although there are some issues around the country, even less so in industrial, warehouse. I mean, it is really an agglomeration of several markets, and some of them are holding up quite well. And if the recession is as moderate as we think it will be, should continue to hold up well. Investors should be looking through the cycle there. And if it is a longer term investment, but I think interest rates, the economy, and painting all real estate with the same brush, to me at least, has something to do with it.
Well, I would agree. And we're not fans of where mortgage rates are right now. I mean, it is difficult for many people today to buy a home, and many people who are sitting on low mortgages, they're not, there's a big lack of incentive for them to move elsewhere. Yeah. But there was a conversation at a recent real estate conference recently in Vegas. And in fact, we're going into the season of real estate and mortgage conferences now this fall, and many of them in Vegas. And what we heard last week from one of the speakers was that people always ask, is now a good time to buy real estate? And let's use a home as an example. Is now a good time to buy a home? And when the public is polled, I don't have the exact number in front of me, but I think it was somewhere between 60 and 70% said no. And so it's always interesting to gauge, again, public sentiment and where it's at. And I think the media is really, did a number on consumer sentiment this year. But if you think today is not a good time to buy a home, what do you think is going to happen to home prices if 6 months from now, mortgage rates are in the mid to low fives versus the low sevens today? Do you think real estate prices are going to go down 6 months from now? So I wonder, how that fits with the consumer psyche.
Well, I think you have to look across the valley. I mean, affordability, to your point, there is a measure going back to the early 1970s. It's as weak as it's been since 1985. Yeah. Now, this is a crazy market. While demand is clearly feeling the effects of higher mortgage rates, the latest increase in mortgage rates, fixed rate mortgages that we've seen over the past month or two, is finally beginning to slow housing demand. We see that from something called mortgage applications for home purchases. It's sort of a weekly barometer of housing demand. It's down to its lowest reading since 1995. So I think if in fact interest rates stay where they are for the next several months, maybe move higher, could see weak demand. Out beyond that, the recovery, lower interest rates, I think provides a better environment, especially with the demographics providing a tailwind.
Okay, we're going to go to a quick break. When we come back, we got some more good stuff to ask Gary. What was the first Disney animated feature movie that was not based on an already existing story? 912-1190. First caller with correct answer wins that tanning certificate. Stay with us. Best of Investing. Be right back. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with my co-host Mark Hanf and our special guest Gary Schlossberg. Trivia question: what was the first Disney animated feature movie that was not based on an already existing story? Gary, what's the answer?
I'm less certain of it now. Snow White, 1937.
No, actually, I think that was the first. That was the first movie that they animated film, I believe, but that was all based on an already existing story. So the answer actually is The Lion King. That was
really?
It was a brand new story.
Brand new story. Right.
So Gary, I wanted to ask you, do you think it's going to matter whether Biden stays in or Trump gets in? You know, we're coming into an election year. How's this going to all be affected?
Or Ramaswamy after last night's
yeah.
Well, I think all three of them just point up the fact that policy has become increasingly distinctive, polarized, separated. The philosophy behind economic policy is the gulf has widened a bit. So yes, I think it does make a big difference. Bidenomics, as the president labeled it, more government intervention, industrial policy guiding those winners and losers. Winners, hopefully. Republicans focus more on the private sector to drive economic growth. That's been around for a while, but I think that's becoming even more distinctive. So economically, I think a lot's on the line between the president and whoever the challenger is on the Republican side. I think it's a variation on a theme on their side.
That's a nice politically correct way to say things. I like that.
Not that judgments for sure.
Well, and how often is there, you know, a real wholesale change in, you know, when it swings back and forth from Democrat to Republican? I'm not sure when you go back and you look at the cycles that it necessarily correlated, at least not initially, to you know, who was in office.
Well, I think there is a pattern to, say, the stock market and the economy, which follows it. You know, the third year of an administration, typically you see the president doing all he can to pump up the economy to the extent he has control by executive authority over spending. And then things pull back in the run up to an election year. But out beyond that, if you're talking about administrations having a difference in policies, I mean, you can go back even before President Reagan, but certainly in the 1980s, I think he redirected things to a point. President Carter started the deregulation move, but President Reagan certainly accentuated it, going from a Republican to the Obama administration. Not that one was right, one was wrong, but I think we did see fundamental differences in the ideology guiding economic policy. And I think that's become even more apparent with the Trump administration moving more to the right on his economic policies, and then moving to the left under President Biden. So I think the swings are certainly accentuated now, and I fully expect that to be the case if the party in power changes after the 2024 election.
Well, I'm still mad at President Trump for passing that tax act that, among other things, eliminated state and local tax deduction, because that's hit us hard. For those of us who are raising capital in the private marketplace, we're kind of limited to raising within our own state, and because who wants to pay California state taxes if you don't have to?
No. but he made up for it by making $1.75 gas versus $5, right? Yeah,
I don't remember it being $1.75 a gallon.
not around here.
I wouldn't give up on that, by the way. It's called SALT, state and local tax, that legislation. The high tax states are still pushing for a higher ceiling, if not an elimination. So hope springs
Fingers
eternal.
crossed.
Yeah, that's right. I was also noticing Americans now have over $1 trillion in credit card balances. I know my wife's contributed handsomely. No, I'm just kidding. No, she's actually been pretty good about that. So, and the average is, I don't know, what are they charging? Are they still charging around 20% for interest?
I checked my cards recently and they were all between 22 and 26%. Yeah. I guess you can call and ask them to lower it too. It's about time I've done that again.
Yeah. That's just, and then, so, I mean, this is the first time it's ever hit over $1 trillion. Do you think we're going to see a lot more bankruptcies coming out in the year?
Well, we're already seeing corporate bankruptcies rise. We're seeing consumer delinquencies on the uptick. The income groups that have been hit hardest by higher inflation, higher interest rates are the lower and lower middle income groups. They are really under pressure. The run up in credit card balances, some of it reflects a strong economy, some of it reflects distressed borrowing, higher percentage of food and energy in the household budget for these lower income groups. And, we've seen the big increases there as well. So we could expect to see some further deterioration in credit quality. Even the suspension of student loans encouraged people to spend and spend by borrowing. They had more cash, they had more financial backing. And now that they're paying off those loans again in October, that could pose an added burden.
It's interesting you mentioned that because, Biden, I mean, even Nancy Pelosi said that Biden didn't have the authority to get rid of student loan debt. It's all political anyway, but it's like, gee, if he wants to be political, why doesn't he say, you know what, we're just going to get rid of everyone's credit card debt. Just let all the taxpayers pay all the, that's a great idea.
Yeah, love that. Did Gary, any thoughts on where mortgage rates might be this time next year? You care to wager? Any thoughts?
Now, either you or Edward pointed this out. They could very well be lower, but getting from here to there, it could be challenging. I wouldn't be surprised to see mortgage rates moving a bit higher before they peaked. It's not etched in stone, but between the Federal Reserve, we think raising interest rates 1, maybe 2 more times. The fact that Treasury yields are as low as they are, and they are the ones that those rates anchor fixed rate mortgages. As they move, fixed rate mortgages move in tandem. We could see those longer term rates move up a little bit further. We may be close to the peak, but we see more upside before the economy buckles a bit, inflation comes down, rates come down with it late next year.
Yeah.
Well, if maybe you can talk to your buddy Powell and kind of
just buddy
nudge him along a little bit. How often do you see him?
I haven't seen him at all, but I used to see Paul Volcker pretty regularly.
Oh, yeah.
He used the same I did when I worked for the Federal Reserve in Washington, D.C.
He was actually a pretty good
I liked him.
economist, wasn't he?
He was an economist, and look, he broke the back of inflation. He didn't win any friends for it, but somebody had to do something.
Yeah.
And he really spearheaded the effort at the Fed. People hated him. The mortgage industry hated him, but inflation was spiraling out of control. So kudos to Paul. I thought he was one of the greatest central bank chairmen because he had the nerve, the fortitude to make that decision.
Yeah.
Right. Okay. All right. You know what? Stay with us, audience. Best of Investing will be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with our special guest, Gary Schlossberg, and my co-host, Mark Hanf. One thing we hadn't talked about is the dollar and also gold. What do you think is going to be happening in the next year or so?
Well, gold and the dollar tend to move in opposite directions. When the dollar is stronger, typically it's higher interest rates that are propelling it. And those are both anathema to the gold market and commodities generally. Stronger dollar just means gold is more expensive to people that have foreign currencies, have to pay more for gold priced in dollars. Our outlook for the dollar, the U.S. may go through a recession, but conditions are even more challenging overseas. They may be cutting interest rates even more aggressively, making U.S. investments, treasury bonds and the like, a bit more attractive. bringing foreign investment here. They have to buy dollars for that. That's good news for U.S. travelers, for consumers. It means our living standards go up because the cost of things purchased from overseas or travel becomes less expensive.
Well, they talked about getting off of the dollar and going on to the yuan for oil. That would be pretty devastating if that happens.
It might, but that's one of the few things I'm comfortable saying isn't going to happen anytime soon. The dollar is supported by a large liquid financial market. The whole infrastructure is built around the dollar. Very difficult for a currency, even like China is the largest economy in the world, the largest trading country in the world. They just don't have the financial markets to accommodate these international transactions. They have capital controls, which are anathema to foreign investors.
And their economy is in a world of hurt, isn't it?
Well, they're facing some headwinds, right? Some pretty serious headwinds. And
well, there's a lot of talk. There's a lot of talk about, I'm sorry, the dollar being bumped from its throne, but I could show you commentary 50 years ago during the first oil crisis where the dollar was under suspicion. So the more things change, the more they stay the same. But
well, especially when OPEC came in, you know, I mean, we all still remember lining up for gas, and you know, you seeing that these guys just got together and started controlling the oil markets. Yeah.
Yeah.
And they wanted to get off the dollar as a currency of payment, but it just isn't going to happen straight away. There are too many fundamental hurdles, things working in the dollar's favor to really make a big move. It'll rise and fall to some extent, but a fundamental change, I just don't think it's going to happen in the foreseeable future.
Do you think AI is going to, how do you think AI is going to come in to affect any of these issues?
I think it's going to be transformative. I think the the interest, the run up in stock prices, the latest being Nvidia's impressive earnings growth. They're very much involved in the AI side. AMD is about to be introducing a chip that will take advantage of that. It can be transformative, but I think typically with a technological innovation like that, you get a lot of interest, the stock price surges, the interest begins to soften a little bit, a more sober view of the outlook. But when the dust settles, we still think that the changes you can see, the improvement in productivity layered on workers could be extraordinary. It could be a game changer for the economy longer term.
I think that AI, for those of us in San Francisco who are bemoaning the high vacancy rate in the commercial buildings, I'm predicting that 3 years from now, we're going to see a pretty high occupancy rate, and most of those buildings, most of those new tenants are going to be companies that don't exist yet.
Yeah, I mean, a lot of venture capital might be coming in, right?
Yeah, the San Francisco Bay Area and Silicon Valley, it looks to be continue to be the hub of innovation, and now it's AI.
Very good. Gary Schlossberg, Chief Economist, Wells Fargo, thank you for joining us. Okay, you ready? Here's our thoughts for the day. So Shakespeare's wife almost left him. Why? Because she was tired of all the drama. And my wife is upset because she thinks I'm obsessed with astronomy. I said, what planet are you on? Okay, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.